Ron Luca here with new collaboration with you, with Rick, also known as Chrono Chartist on X. How are you, man?
Good, thanks, Luca, man. How are you doing?
Really excited about this conference because I always loved your perspectives on cycles and overall macro environment. So would
Thanks, man.
love
Look,
to hear your thoughts on these today.
yeah, that's perfect. I'm also pretty excited to talk to you about it all. I've seen you on Twitter, being more active, sharing really valid and valuable charts. Some things that I honestly looked at that you shared, I was like, well, this is pretty impressive, and I find you to be a very genuine and honest guy, and I can appreciate that. So yeah, looking forward to this talk myself, man. I hope I can share some value. I could probably have put a little bit more time into all of this, but been a busy week for me. So I hope I can bring my part and talk about a few things that we both care about and are passionate about, man.
Sounds good,
Cool.
right? I see you have a chart here on the NASDAQ. I'm curious to hear
Yeah,
your thoughts on this.
yeah. So I'm going to start off with this NASDAQ chart because um, so my view is everything is on cycles, right? So um, there's there's not been such a clear cycle that I can show people, let's say on crypto, than I can show on stocks because it just pops out. It's kind of in your face and it's really hard to miss. And when I first started, or when I first saw the pattern, the cycle, I was very proud of why I pulled this up. Is one, I wanted to show you how interesting this is and how fascinating and cool this is because like I said, it's so clear and clean. If you pull it up on the RSI, well, you can do it on a lot of oscillators actually. So when I look at this and you pull up your RSI, right, you can find on the 30-week time frame. This is the 30-week time frame, and you'll find a trend on the bottom of the RSI and the top. So it's almost a channel. It's not a perfect channel, but it's close to being a perfect channel. And you'll find the bottom all the way from between 2011 and 2012. But this is not where the circular. I'll talk about the circular cycle after I explained a little bit of this, and that's why you see this first cycle not showing the bottom or the top here. It's because the circular bull market started basically in 2013, and I'll show you exactly why. But if you look at the bottoms and the tops, how perfectly it predicted the bottoms on this trend, um, where the tops were also very good, but with bearish divergence. So if you look at the top where the first cycle top hit there, the bearish divergence started, and then almost exactly at the same place. You can pull the same time cycle. This is now just a chart, so it's not a live chart. But if you pull the same time cycle from the first where the bearish divergence started, you'll find the exact same time differences as well between them. So that was very good in seeing and spotting. Helped a lot of people, including myself. So very, very clear and clean. You get your top, you get your bearish divergence, and then the top happens. I mean, like the top of the trend, and then bearish divergence, and then your real top happens. Same thing there, and then same thing there, and then same thing that we had recently. And I kind of expected that to come in, right? I did not expect it to recover as it did. That's where I marked it. I did talk about it though, that it's possible, and it would be possible to even get a 2015 scenario. 2015 did that same thing. Now it's still possible it's doing that, but I'm not leaning on that side anymore, and I'll also show you why. But on 2015, this actually pushed a little bit higher and put in another bearish divergence before it went down to touch the bottom trend line again. So I want you to have a look at this situation here, where we almost have a similar thing happening here, which can be scary because we're still not out of this bearish divergence and we still haven't touched the 3-week bottom here. So one can argue that it's pushing a little bit higher before it actually continues back down and bottoming it out. However, the 3-week very unlikely flips green, and that's why I marked it there in the blue circle there. Whereas every time that has happened, basically, apart from 2015, that indicated a new bull trend, a new cyclical bull market, essentially. So it's possible that it does this, but I'll show you on a weekly as well. Whereas the 2015 had a weekly downtrend, which it broke out of only later, only a year. Whereas all the other times when a weekly broke out of the downtrend, it actually moved out of the cyclical bear market. Now, even with this still being in bear divergence, it's already broken out of a weekly downtrend. So that is also giving it more weight that it's gonna either, if you want to believe it's not, it's still part of the whole same cyclical cycle, that it's ongoing, or if you are like me, believe that it actually might have started a new cyclical cycle. So if you pull down the percentages of each of these corrections or bear markets, so this with previous bear markets and cyclical bear markets actually classifies already with percentage correction wise as a bear market. It just was over pretty quick, similar to 2017. So 2017 was just as quick, was just as shallow as well, and it went on. Now, there was a bigger pattern here that indicated that it was still a bit bearish on larger time frames. And then you can argue that's why COVID also came in, just to touch. If you pull in certain moving averages and certain trend lines and certain Elliott wave theory counts, you can count this as a big pattern here, and it only finished at the COVID bottom. I don't though. I do view this as the cyclical bottom there. So if I pull this up and I go to, let's say, the 2-monthly time frame, you can also see the cyclical cycles there, right? And that's why I believe this was basically not part of not a bear market there, but the bear market was right there, and right there. And then obviously where I believe the circular bull market started, we said we're going to touch base on the circular bull market. So the circular bull market started essentially on that breakout there. So if you pull your line there, and that's where your circular bull market basically started, right? Even though we bottomed in 2008. And that's why when you go back to that chart that I shared, that's why you see this side here not being part of this cyclical cycles, because the cyclical cycle only started actually in 2013 where it broken out. So, and then this whole part here forms part of one circular bull market, which is also fascinating in itself. This period here is basically a circular bear market, and circular bear market right there. Now this big part, that's a circular bull market right there. And the circular bull market, just as we have the smaller cyclical cycles, you have bigger cycles, and you basically call that circular bull markets. So you can argue, we're going to go a little bit more. I don't think it's the end of the circular bull market. I do think it's around about 2028 and 2032, but that's a lot of speculation behind it. I will treat every top as the circular bull top, just for in case, because I don't want to hold through something nasty like the Great Depression, or like the 70s, or the dot-com and the 28 JFC crisis. So anyway, that's very interesting to look at this way. And then also I can quickly pull up that chart of mine that's on Twitter that I've pinned. That's essentially what you see in front of you here. I did make some minor adjustments back in 1942 and 1947 from this chart, but this basically shows you the circular bear market and how long it took. And then over here, the same over there, and then the same with the bull markets, circular bull market. Now, if you look at the circular bull market that we are in, that's these blue and red ones here. See, I've been tracking them for some time. And I overlaid the BTC chart because you can see how Bitcoin was basically born into a circular bull market. So Satoshi definitely knew what he was doing when he made Bitcoin, because he made it at the exact right time. Now you can argue that he made it, because of the cracks that he saw in the markets because of the whole crisis that we had in the circular bear market, and that's why he did what he did. But essentially, Bitcoin has only been in a bull market, a circular bull market. So that's pretty cool and pretty fascinating to see. The reason why I just wanted to touch on this is that's where I wanted you to know where my thesis comes from. So with the cycles, because the NASDAQ and the SPX does correlate pretty strongly with Bitcoin. Not so much the first part with 2013 and 2012, that wasn't so strongly, but from 2017 onwards, it's correlated pretty strongly. So also when there's like big, it's hard to stay out of the panic zones out. So like if we get a major panic like this, like what the bear market is, or there, or even there, you will see crypto gets influenced. So for me, it was like, well, crypto probably won't go against the grain when the whole world's panicking and the news is blabbering some nonsense narrative that it's the end of the world and blah, blah, blah. And then, we'll probably get a harsh correction in crypto as well. The concerning part is that we're still in that bearish divergence and we're still pushing higher, which is good because the trend is flipping. Not only the weekly is flipped a while ago now, but the 30 weekly has also flipped, which is good. So keep in mind, it is good. It is pointing upwards, but we're still having this little concern yet. Global liquidity. Everyone knows this by now. Everyone loves it. So I'm just having that on there. Then I want people to understand something. If you take this exact M2, this exact one, and you just put it on, you just set it to be percentage year over year, then you get this chart. This is the exact same M2 global liquidity, but it's just put in percentage year over year change, right? And that's how it looks. It's actually very low still, but it's driving up, right? Why? This is very important for me to share because people think it leads, and I want to actually bring it up and just show that is not per se the fact behind the story. And then besides that, people being fascinated with this is just basically looking at an inverse Dixie, a DXY. So keep that in mind. So I'm just going to drop away the purple because now we know what we're looking at. Right? So I'm going to drop that guy away. That's what we're sitting with at the moment, right? Then I want to show something very interesting now. And this is the inverse dollar, right? Inverse DXY. So you can see if you bring that up, it's basically like for like. The trend and the correlation is very, very strong. Very, very close. So what people have been looking at is just that. It's basically an inverse DXY because it just makes sense, right? If you've got a stronger dollar, it's going to influence global liquidity. If you've got a weaker dollar, the opposite stands, the inverse correlation of it. It's due to different reasons. There's something called the dollar global roll. When the dollar is more expensive to countries to borrow, right, and transact in those dollars, that constrains global liquidity, right? And it slows M2 basically down, which consists out of deposits, cash, and all such things. And the opposite also counts. Also holds true. So fall in the XY will basically coincide with looser US policies as well, encouraging global liquidity and M2 expansion. That's why you kind of see what you're seeing in front of you there. So I'm going to take away the dollar now and just leave M2 on there because that needs to stay on there. That's important. The next important bit, which is manufacturing. But this is the diffusion index. I focus a lot on the diffusion indexes. So the PMI diffusion index, the proportion of countries whose manufacturing PMI is above or equal to 50. So you're looking at all the countries that has above 50 basically manufacturing levels. And that's important because the US manufacturing can be low, but China's can be ticking higher, or Japan, or whoever. And then you look at basically that overall strength, and you'll get a little bit of a different result. So I'm keeping that up here because I want you to see as well how these correlate with each other. Now, again, I did say in a recent tweet that correlation does not equal causation. So you got your manufacturing, but you got global manufacturing there, right? Then I want to pull up the guy that I like the most, and that is the CLI diffusion index. So now you can see the correlation, but the CLI tends to lead a little bit more, right? So you can see when the CLI drops, which is the black one or the brown one there, then manufacturing, and then M2. Same year, and same there. Every now and then you might get one that front runs the other one, but majority they do the same thing, and CLI leads. So I just want to show that and pull away my mouse So you can see how the CLI leads yourself, and all the viewers can see that. And then the manufacturing, and then global M2. One last guy I want to put on there is Bitcoin. So we've got Bitcoin on there now. And I'm going to take this part out so we can just have a better look on this, where Bitcoin is. So it still looks messy. So I'm going to do that again. Now that you all know what you're looking at, I'm going to drop the CLI away first, and I'm going to drop M2 away. Let's do manufacturing. So you can see manufacturing dropped off here first, and then Bitcoin dropped off. Manufacturing dropped off, not heavily, but it started drop off. Then Bitcoin, same there, 2017, and same there with 2021. I do believe that my top was basically there because of all the other macroeconomics starting being weaker and weaker. But that is basically where the bearish divergence started. So that is top still on Bitcoin. However, where the weakness in the market started was basically when manufacturing topped out. Now, when did I become very bearish on Bitcoin? I became bearish on Bitcoin after my thesis on March 2025. Well, end of February 2025, I recognized that March would probably not be valid anymore. So I called it there already. And 95 was like the break point. This is where I basically got very bearish, this 95 point, because I saw how manufacturing was dropping off. Not only manufacturing, but also the CLI. But the CLI started pulling up again. So when this data was still coming out, it was lower than manufacturing was, way lower. And I was like, well, this is a very bad sign, red flag. And we're probably just going to get a dead cat bounce. With that dead cat bounce, the CLI data, like I said, was still coming out. It still hasn't made a higher high, but the trend, when 95 got broken, I was still hesitant. And I'll show on the Tether dominance. I tracked Tether dominance since this part, because that all my focus shifted in this area to altcoins. So I don't even look at Bitcoin all that much. I just look at for confluence, but all my focus is on altcoins at the moment. And for that, Tether dominance is extremely important for me. And then we'll just bring up the M2 that I wanted to show. So now we can see M2 data still needs to come out unless you just put it on TradingView. But with the thing that's being the most accurate with the tops is technically M2, but it's later. If you look at M2, it's later than the 2017. On the 2021, it was a bit earlier. And then over here, it is still kind of in no man's land. But with 2013, it was the best. And I mean, with 2011, 2013, it was actually very lagging. It was only on the dead cat bounce when it showed a top, where CLI dropped off first, manufacturing dropped off second, and M2 dropped off third. Whereas the same with 2017, CLI first, then manufacturing, and then M2. And over here, CLI dropped off first, then M2, and then manufacturing. So a little bit not exactly the same as the two previous cycles, but very close, you know. So this is the most important data that I look at. But if you really want to give my input now, after the trends has been basically invalidated and kept moving up on Bitcoin, I would say not M2, but DXY. And because it's weakness, it just makes sense that things like gold would push up and things like Bitcoin would push up. However, copper over gold proves to you that it's more of a risk-on environment, because copper is more of where investors goes when they have an investing appetite, or risk-on appetite. Let me put it that way. Compared to gold, whereas people are like, oh, risk off, so let's go to gold. We're completely kind of not, in a sense, if you think about it, because the whole 2022 market with stocks and Bitcoin went up with gold. So gold's performing really well, obviously, but with copper outperforming gold. You need to keep in mind that the stock market and Bitcoin went up since 2022 now against the grain. Like the fusion index shows up, yes. But if you look at just the US manufacturing, I haven't got it in front of me now, or copper over gold, it's only turning bullish now. Copper had a major breakout now, and that's what we want to see. However, if the sentiment's right and there is tailwinds and not headwinds, why not? And if the trend is with it, I'm all for it. I'm not going to fight it. I'm like, bring it. I'm in altcoins. I want to make money. Let's do this. That's all the boring stuff, but this is a chart that's pulled my attention and I like it a lot, right? So again, I'm just good in putting puzzles together. You can work out the mining cost yourselves and the rate, but they've basically put a ratio here of a 30-day moving average in the mix, which is pretty nice. And then besides that is I like seeing this major deviation between the mining cost and Bitcoin price. You can clearly see it expanding, or going in expansion. And then that tells you exactly, in my view, what the mining cost or the miners thinks, right? And then that's basically your euphoria stage according to this chart. So you can see it deviate there, and it goes pretty full on. You get that euphoria, you get that gap there, and then the same with 2021. And then when you look at what we're seeing this far, we haven't had that same gap yet. We haven't had that same difference in price. When you do start to see this big gap, I think you need to know that probably is the start of the end, But for now, it's pretty close still, and we're still trending down. Yeah. I want to talk about go back to the very first chart that I shared with the NASDAQ, right? So I pulled the NASDAQ on here just to show the correlation again with Bitcoin from basically 2016, 2017. If you essentially follow those cycles that I've put on NASDAQ, you do tend to get a very similar time to basically where we are there. And then this had a lot of credence right there, that area, to have been a dead cat. That's why I was kept on saying, people say, oh, I was bearish this whole time up. No, I called for a dead cat bounce in the below 80s, but to 95. And then from 95, things started to ski off from my point of view, where I was in and out. But anyway, I digress again. This was very valid for a dead cat because of the cyclicals that I've been following. And then if you look at the trend that we had, and this is a monthly. Every time we hit this trend on the bottom, it was pretty bearish, apart from 2017 again. Very interesting that you brought that up, right? So every time we hit this trend, basically negative, basically bearish, and we had this bearish divergence come in, which coincided with the NASDAQ bearish divergence as well. That's why I put it in there, that bearish divergence and that bearish divergence, which showed basically the Bitcoin, to me, that Bitcoin top was validated, or well, it was valid to be a top, and then this would be a dead cat. Then the same thing with the trends here. Like I had this playing out on the higher time frame though, so not on the lower time frame. So you can argue it's probably still valid, but I mean, like I said, the trends is unequivocally bullish for a while now. So to view it this way still is a little bit hard now, but why I viewed it like that for a while is because so many cyclical indicators and the view I had still showed me that this was pretty bearish, and we could have had something there which was similar to when we got that bounce there. But as soon as we broke down, and we'll go to the daily now, then I started to notice it as well, and I started to post about it. But anyway, the NASDAQ, that's why I just wanted to pull that up, because people have been following now from the start, and they know now where these cyclical cycles come from, how the correlation is. So when NASDAQ drops, it's probably likely that Bitcoin's going to drop, even if it's not in the immediate term. With this that I pulled up there, showing how that is very similar to that, or was similar, apart from this major breakdown. So you can definitely, there was this major breakdown of trend when structure started to break down, back tested it, and higher time frames bearish. It still had the same pattern basically that we have here, and it could have gone up before it went down again. But anyway, now it's starting to turn downwards again, and then we can look at the daily, and this whole area here is what I wanted to show. Was still also how I got this right as well, is because this was still in a very fractal pattern way to that and that. And it reacted the same way. You had your bearish divergence or your bullish divergence on dominance, obviously. But if I'm saying that, I'm just saying on Bitcoin. And then you had like your small divergence there, each side, which indicated the bottom. Bottoms and tops likes divergences, but you need to know what to look for because they can be part of an impulse. I can touch a little bit on that as well. But that gave us that divergence. And I tracked this all the while. People think Bitcoin this or Bitcoin that, but this was pretty accurate for a while. And I did say as well, when this breaks down, like it becomes bullish again. So this was bearish. Each time it hit the bottom, puts in the bullish divergence, and that basically created what we saw there, what we saw there, and what we definitely saw there. But then, as soon as this broke down there on the trend, that's where I said, right, trend's flipping again, and that's when I'm bullish, and people freaked out about it. But I just follow what I see, and this is where it all came from. It all came from this credence, and it was all valid. But on the higher time frame, like I've just showed you, yes, I did not argue once that this is not a breakdown. I do believe that, and I just believe like I need to follow trend, and trend showed me up, and then it showed me down, and that's what I'm now. And now again, I do want to point this out. It is concerning. We did get that bounce there, that small bounce there on the trend line again, but as soon as it starts, let me just get rid of all these lines quickly. As soon as it starts breaking down, as soon as it's not perfectly clear anymore, yes, it can be a deviation, but it is a indication that something is changing. Like something is changing.
Yep.
And to me, that tells me something is changing already. So for me, I don't believe this will have the same effect as this anymore, or this impulse. That was a breakdown that we needed. And this, even though we get the bounce again on the trend, this bounce. But if you go to a higher time frame, let's say the 3-day, you also get a trend there. It was pretty good in tracking it on the 3-day. And on that, you can basically see it already broke down of that higher time frame. Onya, which shows you the point of control. So this gray area is a point of control, point of control, point of control, right? This is a liquidity level, and this is another point of control. Now, price tends to go, however you see it, you know, gaps and volumes and so on. Price tends to go for these point of control levels, or at least go touch the liquidity level. It fills it sometimes, but it at least goes for a touch if it goes from a point of control level. So you can see exactly where the bounce came in. I'm just going to remove that again. So the bounce came in on that point of control, to be expected. The market was definitely overheated. You can see that on most oscillators, on the daily and so on. And now we're getting the bounce, and you can expect that rejection on this point of control level. And that point of control level will have confluence with this trend here. So if you pull that trend up, you'll see most likely when this level gets hit right here, you'll get the retest there. And I would be expecting, you have to assume resistance, you know, we'll get a rejection. So I have to assume that we're going to reject there. And it's not only on the 3 daily that we got this point of control level. So I'm just going to put that in there, because you do want to have good volume confluence. So if we put that in there, you've got those two levels there, and we go to a lower time frame. Let's say that the 2 daily, it's very close. There's one slightly above it on that time frame, but it's close. You're basically on the same level. And then when you go to the weekly, again, you see how that high volume sits there. Everyone can see that volume block there. That is a major level, meaning a rejection here is very likely. If we do lose this level, in my opinion, then yes, then you're probably going to get a retest, and we're probably going to go a bit higher again. I still don't think it will be major concerning though, but that could obviously hurt the altcoins.
Yeah.
That's just my current view on Tether dominance and where it stemmed from, again, with the cycles.
I think that because we're in a post-halving year, right? There are a lot of people a couple of weeks ago that were saying that we're going to have a prolonged consolidation phase because Q3 always tends to be weak from a seasonality standpoint.
Okay.
But we're in a post-halving year, and historically, all the post-halving years have been strong. 2013, 2017, and 2021. They have all been strong. So you had, from a probability standpoint, a low likelihood that now we're going to see a prolonged consolidation phase. And I think that the USDT dominance beautifully reflects that.
Yeah, don't think you're wrong. I don't fully agree with the halving cycles though, but I do agree with the seasonality, with the sentiment behind it, and then also with the um, presidential cycle. But I do agree with you. Look at the seasonality is something to look at, and I mean structure is obvious. Anyone can flip an indicator on you, a moving average or whatnot, and they'll see the high time frame trend is in bearish. Yeah, this is not this that I've got here is bearish, which is obviously good for altcoins and Bitcoin.
Yep. All right. So now moving to my charts, we have Bitcoin. And this is a thesis I've discussed many times before. I'm sure many of you are already familiar with it. With the conferences I've been tracking over the last couple of months, I was actually on the same boat as Rick was back in December. And when we were in this range, I thought that this was it. This was the cycle top. This was when we saw Bitcoin dominance crashing. So if we correlate this with the Bitcoin dominance, we actually see that we had a big drop. And as we all know, the Bitcoin dominance crashing signals that there's a very high risk appetite in the markets, which generally tends to lead to cycle top formations. Because as we have a distribution towards altcoins, it signals that there's a lot of investors out there who are taking a lot of risks. So generally that is used by market makers as a way to distribute, which as we'll go on a couple of Glassnode data metrics, we actually saw a small distribution, but still there was some distribution around these levels. So here I thought that, okay, this was it. But some of the confluences that then invalidated this thesis of mine was the way we went down, because we didn't have a straight crash like we had back in 2021 that would imply that the distribution already took place and now it is basically a low volume market and we are just crashing down without no proper buying pressure. And also another very interesting thing is that the Bitcoin dominance actually went up, which signals that the risk appetite lowers. So there's a rotation back into Bitcoin. And that means that we're going to see strength. And generally that leads to reversals. Once the Bitcoin dominance is strong once again, it signals that there's still not a sufficiently high risk appetite to lead to a genuine macro top formation, the one I thought we would have had. So this was a very strong invalidation for me personally. Now, the way we went down was very interesting for me because this is what I've been tracking. We had pretty much a single POI, which is a point of interest, which was the weekly bull market support band. So we see here acting as a resistance over and over again. So this was pretty much the invalidation of the downtrend. Once the price were to break above this bull market support band, then we would have had a bullish reversal and then pretty much a durable bounce. But the way we went down, as I've said many times before, and this is also what kept me bullish here, was that throughout this downturn, we had series of untapped lows developing, and then these were followed by a tariff announcement. Now, if it happened one time, okay, that would have been a coincidence. But because it happened so many times all throughout January, as you guys can see here, and all throughout March, and all throughout early April, I mean, it happened over and over and over again, that it cannot be a coincidence. So my thesis at the time was, and I still believe in it, and this is important moving forward, because this is how I believe market makers have managed to use retail as their counterparty to accumulate. By setting these liquidity traps and series of untapped lows, this is where traders generally set their stop losses at. So generally what we see is a bunch of stop losses sitting at these levels, and then once some news or some headline comes out, we have a liquidation cascade. Now, liquidation cascade forces all of those stop losses out of the market, and those stop losses of long positions are equal to forced sell orders, which is the perfect counterparty for market makers who are trying to accumulate. And because we've seen this over and over again, this is how I believe market makers have managed to accumulate all throughout this downtrend. So once I identified these series of untapped lows, I just hedged myself, positioned for a potential move to the downside. Once we saw it, I then scaled out of my short positions and then rotated back into spot holdings. And because we had such a clear POI and invalidation for this downtrend, which was the bull market support band, once I saw a break above this bull market support band, I flipped bullish. Now, this is quite important because I also use the bull market support band as a way to see whether we get a prolonged consolidation phase or not. Now here we had a breakdown. Back in late June, we had a breakdown below the bull market support band. So this technically would have been an invalidation. But I decided that before I would hedge myself and before I would have gave up on my bullish thesis, I would want to wait for a bearish retest and then a continuation back to downside. So I waited for the bearish retest, and there was not a bearish retest, but this ended up being just a deviation. And because we, at the time, we saw a bunch of bearish narratives, the rising geopolitical tensions, and all of those bearish narratives that I think have played a major role in setting up this move to the upside. Because the way we reversed, and I apologize to my audience because this is a thesis that I've explained too many times now. But the way we reversed was very interesting because suppose you sell here at the bottom, then you wait for some sort of pullback. Once we test this resistance range, you don't see a pullback, right? The price just chops for a couple of days before it goes even higher. Then here you pretty much do the same thing, because if you look on the low time frames, how the price action has developed, you see here the price forming higher highs. If you look at the RSI, you see the RSI forming lower highs, suggesting weakness. So here, normally, you look at this price action and you say, okay, I'm not going to buy this. We are seeing clear bearish divergences. So it is clear that you don't want to buy here, but the price goes even higher. And then here we test the all-time high resistance range. It's a high time frame resistance range. So normally you don't want to buy here, but the price eventually goes even higher. What this price action has done to people who have basically sold at the bottom is that it made a bunch of people be very attached to their bearish buys. And this is very important because then we saw a couple of weeks here from late May to late June when we saw constant bearish narratives. We saw tariff headlines reemerging once again. We saw the rising geopolitical tensions between Israel and Iran. And so this acts as a very strong confirmation bias, because throughout this move up, you got attached to your bearish bias, and now you seek for confirmations. And I think that this is the reason why we've seen so many bearish narratives when we were in this range. Now, here, there were also a lot of correlations with what happened back in 2021, with the fractal from 2021, or with the Q3 weakness narrative, or with all of the prolonged consolidation phases we've seen back in 2023 or back in 2024. The 2023 correlation was actually very interesting because it would have made some sense that we could see it due to the fact that back in 2023, we also had a deviation above the highs here and then a prolonged consolidation phase. So in case we would have seen a breakdown below the bull market support band, as you can see here, we saw a breakdown and then we failed to reclaim it. So this was pretty much my invalidation point, a failure to reclaim this bull market support band. This was what I was watching. This was actually my invalidation scenario. In case we would have failed to break above the bull market support band, this scenario would have been likely to occur due to how many similarities there were with this. But I refrained from shifting my stance until we saw durable invalidation, because from an Elliott wave standpoint, which I use quite a lot in my analysis, this was actually a corrective wave 2 that would have normally preceded an impulsive wave 3, which I believe we're currently in right now. And my Elliott wave count for this move to the upside is currently looking something like this. Now, this is important because from an Elliott wave perspective, the impulsive wave 3 is generally the most impulsive and strongest wave out of all. And this also matches with my emotional gap thesis, which I first developed back in September of 2024, when we had pretty much an extreme fear environment all throughout June to August and September. This is where a lot of people have increased their cash positions to prepare themselves for lower prices, right? And this is where market makers generally accumulate and use retail as their counterparty, as we've seen all throughout early 2025 with all of those liquidation cascades and liquidity traps that have developed. And then we have this disbelief environment where the price reverses, but we don't have a lot of euphoria in the markets. We don't have a lot of people that are saying, okay, now it's finally the time to be bullish. Now it's finally the time to go up. Because at the time back in 2024 as well, we were testing this high time frame resistance range. So normally you don't want to be bullish here because, of course, this is programmed beforehand. We have constant rejection. So assume you're a retail trader. Generally, this is the mentality of a retail trader. And I'm not saying I'm a retail trader as well, but generally someone who trades a lot, who has knowledge in one-on-one technical analysis, which, by the way, market makers use and algorithms use. Everyone basically knows one-on-one technical analysis. And so this is being used by market makers as a way to create these liquidity traps like we've seen here, right? Because here there were a lot of stop losses that were sitting at these levels because these are intuitive stop losses levels rather than nearest low. So of course you're going to have a move to the downside. Now, returning to what I was saying, back in 2024, we had constant rejection. So you see here the first rejection, you see here the second rejection, but here you start hoping. Here you start saying that, okay, this looks like an impulsive market structure. This looks from an Elliott wave standpoint like a 1, 2, 3 move to the upside. So this is kind of where you can be bullish, right? So you take a long position. Here you have clear stop losses so you don't lose too much. Here your stop loss gets triggered. Here your stop loss gets triggered. So what are you going to do? You look at the prices going down. You may take a long position once again. Then you look at the price going up. You take a long position here and your stop loss gets triggered. Basically, once again, you lose. But then the next time this resistance gets tested, you tell yourself, okay, I'm not going to do the same mistake once again. Instead, what I'm going to do is short. Then you have an initial rejection and people start hoping for a prolonged consolidation phase. And I say prolonged consolidation phase because I think that this is pretty much what we've seen back here in June and when we saw this downtrend. And then eventually we have the final phase, which is the emotional gap. And this is my emotional gap thesis, which implies that there's a very rapid transition from this state of anxiety and uncertainty to a state of full-blown euphoria. And I believe that this is how market makers have managed to make retail increase their cash positions here. Then they didn't allow them to buy throughout this move up because they didn't think that this was the actual reversal. And then eventually they are forced to buy in the distribution phase where market makers start distributing their shares. And I would also like us to go on a couple of Glassnode data metrics because these are all trackable metrics. These are all public, so we can track it. But yeah, this is my overall thesis, and this is what sort of kept me bullish here and allowed me to keep accumulating, because once I identified these liquidation cascades and liquidity traps, I knew that market makers were positioning themselves for something bigger in the coming weeks and months. And I think that we're currently in the final phase. I believe that this was the extreme fear environment where a lot of people were very anxious about tariffs and very anxious about the potential stagflation. Then we had the disbelief environment where retail didn't really buy into the reversal. They didn't really think that that was the genuine reversal. And as I've shown earlier, instead of having any substantial pullback along the way, we've only had shallow consolidation phases. And eventually we're hit by the emotional gap phase where retail is starting to become euphoric. And this is also where I believe that your narrative around altcoins outperforming comes into play, because I completely agree that I believe that with this risk on environment and emotional gap being in play, altcoins are very likely to start outperforming because of the elevated risk appetite in the markets. So I think that this really plays a big role, but we have to remember, that an alt season has historically coincided with the cycle top formation. And I think the reason why alt seasons have historically coincided with cycle top formations is that in order to have a proper alt season and durable outperformance of altcoins against Bitcoin, we need to have a very strong risk. We need to have a very high risk appetite in the markets that is generally produced by a very strong narrative. And this is where my overall macro environment narrative comes into play, that I believe what will lead to this distribution phase will in fact be the end of quantitative tightening narrative and the Fed finally transitioning away from their quantitative tightening policies and everybody becoming euphoric around the idea that new liquidity will get injected in the markets and that we'll have higher prices and that risk assets are going to benefit off of that. I think this is the main narrative and catalyst that could lead to an alt season and proper distribution phase in Bitcoin. But yeah, this is my overall thesis. What do you think?
I like it, Luca. I like generally, I'm pretty impressed with how you described each phase that we've gone through. Because as you know, I've been with you all the way with regards to this cycle. I mean, like the whole cycle. I've been part of it all. And as you explained the sentiment on each, while you described the liquidity grabs, it was almost exactly like you explained it. The sentiment was on each phase that you explained, was with disbelief, with the anxiety that the people felt in certain stages, and then with being left behind, basically with that liquidity gap, or not with the liquidity gap, but with your euphoric gap thesis is pretty bang on, man. I can't argue with that at all. It's pretty good. I like it. I like it all. I agree with you, majority of it all, especially with this last part that we recently had between April and May, where you also said, or well, May to June, basically, where you said people clung on to the bearish thesis, including me, because when 95 broke, I actually said, because I jumped in at 78 or lower, actually, back just after March. And I said, basically, if 95 gets broken, the weekly trend will flip. And I saw that happening. But I still, when 95 broke, though, that's actually when I became a little bit more bearish because I was like, righto, this is all part of my cycle thesis that it's part of a dead cat. Even though I never go against the trend, I did go against the trend there. And I kind of fell in that same trap with that whole place, with that whole second part of price action above 95. I always climbed, had a few trades climbing out and in, but my thesis remained the same. So that is pretty well explained, man. I think it's very good. I think it's very valid. I'm not sure about your Elliott wave. I'm not an Elliott wave tician, so I can't really give any input there. But apart from that, your whole description and your whole analysis is very, very good and very accurate. The narrative that you said, just to conclude, I'm not sure about that one. We can obviously speculate, but I do know that the whole thing about the policy changing of liquidating or not liquidating, but pulling out of your 401k, the Americans, to be able to push it into the markets, that might be a little bit of thing to speculate on. That could add to added liquidity as well. And then
Yeah.
there's heaps of liquidity coming from China. China's M1 is rocketing. HSI, the HSI is also going up, and
Yep.
there is liquidity in the market, even though it's in a quantitative tightening environment, like you explained earlier. There's definitely still a lot of liquidity in the market, so there's enough. And then I do agree with you with altcoins, obviously, as well. I'm not sure exactly how it's going to look and how it's going to end up. Not anymore, but I do agree with you, and I do think that's the next phase. And I think everyone needs to pay attention to what you explained on how it looked with the distribution phases. So yeah, anyway,
Yep.
that's it.
I also have a very interesting chart here, which is the ETH to Bitcoin pair and its correlation with the total assets of the Fed. And this
Mm.
is basically the reason why I said earlier that what I believe will lead to an alt season will be the end of quantitative tightening, because this is exactly what led to the ETH to Bitcoin pair going up back in 2019. Right where the Fed ended their quantitative tightening measures, that's when we've seen basically the ETH to Bitcoin pair bottoming out. And I think that now the markets may be front running this, because now there's a even higher risk appetite, because now we have been essentially in a bull market, unlike 2019 when we were essentially in a bear market, right? Bitcoin wasn't really going up. And now I
That's
think we
very,
may be,
yeah.
yeah, now I think we may be front running that. Now, moving on to the Velo data, I want to show something here very interesting that has caught my attention over the last couple of weeks, and the confluences that I'll be tracking moving forward. Generally, we want to pay attention to three main metrics here, which is the open interest, the funding rates, and the premium metric. Now, for those that may not know, the premium metric measures the difference between futures prices and spot prices. When we see the premium metric flipping into positive territories, like we've seen it flipping over the last couple of days, it signals that that is becoming a perpetual driven rally. And generally, these are not sustainable. Generally, what we see is that once the premium metric enters positive territories, like we've seen it back in February, for example, it leads to market corrections or local top formations. Or, for example, like in late January, it led to this whole downtrend. Or like we've seen it back in November, when we were in this high time frame distribution range, the premium metric was deep into positive territories. Of course, this was essentially the macro top formation that led basically to a 5-month either consolidation or downtrend. So the premium metric is very interesting. And another very interesting metric are the funding rates. Now, the funding rates measure the ratio between longs and shorts. Once the funding rates go astronomically high, like they've done back in November, it signals that there are a lot of long positions that have been piling in over the last couple of days or weeks. And so that signals that that move is nearing its end because market makers no longer have a counterparty to trade with. So everybody is on the long side. So now the price has to go down forcefully because nobody can be on the same boat and the price just keeps on going higher. Because we always need to have somebody who loses money. This is a zero-sum game. So there are always going to be bears that are needed in order for the price to go higher. And so that's the reasoning behind why I think that the premium metric and the funding rates are a very useful tool. And if we correlate this with the open interest, the open interest is actually very interesting because over the last couple of days, we have essentially been in this consolidation range, but the open interest has been going lower. Now, this signals that there are fewer perpetual positions, but we cannot really assess whether there are fewer shorts or fewer longs. Generally, this is when funding rates come into play. And as we can see here, funding rates have been going lower. So this suggests that because the funding rates measure the ratio between longs and shorts, this suggests that there are fewer longs or more shorts that have been piling in. Now, also another very interesting metric is the premium, which the premium, as I've said earlier, measures the difference between future prices and spot prices. Because we've seen it in positive territories over the last couple of days, I've decided to de-risk a bit of my Bitcoin holdings. And I'm now currently rotating the profits I've secured from Bitcoin into altcoins because I think that there's a better risk reward setup there. And altcoins have been going lower by a lot over the last couple of days. Now, finally moving to the ASOPR metric, which has really caught my attention over the last couple of days. We've discussed it, what it implies in prior videos. For those that did not watch them, it basically measures the amount of Bitcoins in profit that are being sold. And the reason why we want to pay attention to this metric is because once we see multiple spikes, like we've seen, for example, back in 2017, when we saw this cycle top formation, we saw multiple spikes and very big spikes. Now, when we see these very big spikes, it signals that there are a lot of Bitcoins that are being sold in profit. And that generally signals distribution. We saw the same thing happening once again back in 2019. And this led eventually to the COVID crash. The same thing has happened once again before this distribution range back in 2021. And then later on, as we were going to the cycle top formation, we saw another big spike here. Now, the closest we've ever gotten to a distribution range this cycle was back in March of 2024. And the reason why I'm mentioning this ASOPR metric is because that earlier we were talking about an alt season. I believe that in order to see a proper alt season, we'll have to see a distribution. And this distribution can be tracked through this ASOPR metric because when we see multiple spikes like we've seen back in March, as we all remember, back in March, altcoins were doing absolutely great. And so I think that the reason why altcoins were doing so good, especially meme coins, as we all remember in May of 2024, is that we had multiple spikes in this ASOPR metric. And so there was enough liquidity to start flowing into altcoins. Now, however, we've only seen one big spike. And I think that in order to see a proper distribution phase or a proper alt season, we'll have to see 3 to 4 to 5 of these spikes in order to say that, okay, this is starting to become a proper distribution range.
I agree. It's very interesting that the ASOPR shows that spike on the distribution where you pointed out the March, and then you can see that bear divergence coming to the next top, which doesn't have the spike, similar to 2021. But then 2017 had that major spike where altcoins just skyrocketed. And because we haven't gotten alt season, or like alt season in brackets, if you will, for the whole cycle, basically, it does make a lot of sense. Does make a lot of sense that you can track this in a distribution view, and then to judge, because you can obviously look at the confluence with others and others' dominance, and then also with Ethereum. Ethereum breaking out of a strong resistance line that came a very long time is a very indicative in itself. And if you line it up with what you're showing here now, makes 100% sense. I think obviously with the pullback that we're having, I think people need to always be careful and stay on the safe side. But at the same time, the risk now at this point in time is basically, in my opinion, being out of altcoins, because the thing that can happen with altcoins is not something you really want to miss. So I would not just jump in with leverage, but I would definitely, if you haven't looked at altcoin positions, would definitely just start having a plan together. It doesn't mean jump in now, just to have a plan together, because the pullback might be a discount and it might be a very very good gift. Just have a look, and then have a look at this chart that Luca just shared. I think this is a very good chart to track on the on-chain side of things with distribution. It's very good.
Yep. Yeah, man. That's pretty much what I had to share today.
Yeah, love it. Love it,
And
Luca.
I think that this pretty much wraps up our collaboration together.
Luca, sorry if I took you a little bit too long there, but I enjoyed it. I enjoyed my time, and I learned a little bit from you tonight. And I definitely liked getting to know you a bit better and your analysis. I think you're definitely well worth the follow. I think everyone that's listening into this, if it's some of my followers, some of my loyal community guys, definitely hit Luca up. I think you'll not regret it. So thank you, Luca. I appreciate it, and I appreciate having me on, man.
Appreciate it too. Likewise, man. Always enjoy seeing your perspectives, and I really learned a lot throughout this conference and market talk together about the correlations with the PMI. Those were really interesting, and I appreciate you coming on.
Perfect. Thanks, Luca, man. You have a great night.
All right, man. Have a nice day.